Jonathan Blau, welcome into the show.
Thank you, Matthew. Very, very glad to be here as a guest today.
Well, we got a lot of people who listen that are out there either already building and, scaling their businesses, their income, their wealth. And we've got people that are thinking about it and have dreams of, a vision, a future, financial freedom, of creating that generational wealth for themselves, their family, their future family. And I know this is something that you guys obsess over. You eat, sleep, and breathe it every single day. So what does Fusion Family Wealth do, and what makes you guys so unique and different in your perspectives and execution?
Sure, thank you. So we work in an industry where the investor is generally seeking from someone who does what we do as much certainty about the financial future as they can get. And the industry typically looks to resolve that issue, a desire, by handing back to the client or the investor what I call the illusion of certainty. They're going to tell them we're this big Goldman Sachs or UBS. We have 100,000 analysts and economists, and we're going to tell you based on their expertise what the economy is about to do, and from that we'll help you glean when and when not to go in and out of the markets consistently. And we're going to tell you which industries, based on our analyst roster, are going to be in favor and out of favor in the next 10 minutes and the next 20 minutes, so you can get in and out of those industries at the right time. And we're going to hand you back those sorts of illusions of certainty. And what we do that's unique is we tell people that timing the market and forecasting the economy consistently are impossibilities. And so rather than hand you any illusions, we're going to teach you how to consistently make rational decisions based on how human nature has programmed us to be irrational, particularly when we're faced with making decisions about money under conditions of uncertainty. So while the industry focuses on trying to figure out what's going to happen next so that they can give you the illusion of more certainty about your financial future, we teach you that no one knows what's going to happen next. It's irrelevant to a long-term plan, but we're going to teach you how to develop a plan and stick to it by giving you the ability to fight human nature instincts to do the opposite of what you should be doing in the face of all the fads and fears that you're going to be confronted with over the next multi-decade period of your investment horizon.
Now, are you guys, helping people with their trusts, their wills, their estate plans, their actual investments themselves, or what does kind of the scope of work consist of from your firm?
Sure. So that's a good question, because the first thing that we do is we come up with a plan for each client, right? It doesn't have to be a formal written plan. It's just a plan. And usually it should always be date specific and dollar specific. So for example, someone comes in and they want to know, how much principal do I need to accumulate in order to be able to retire within 10 years and be able to retire comfortably and stay comfortably retired for the rest of my life? So the first thing we need to do is say, okay, well, how much do you earn now? How much do you need to want to spend in retirement? And then we figure out what that amount of spending would require us to accumulate to generate it in 5 years or 10 years. And then we figure out, what do you need to do to get there? Do you need to work an extra 3 years than you thought to get to that principal sum accumulation? Do you need to spend a little less now so that you can have a little more later? Because planning is always a science of choices, right? And that's something people need to accept. I can't just have it all. And then once we come up with a plan that's date specific like that and dollar specific, then what we do is we'll invest the money for them, and we only use index funds. I don't know if you're familiar. For the audience who's not familiar, an index is something like the Standard & Poor's 500. That's an index of the 500 most profitable, best managed, and best financed companies in America and the world. And a guy named John Bogle, who created the Vanguard firm many decades ago, he's passed away in the last year or two. He made it available to the investor to be able to buy that whole basket of S&P 500 securities in one security called an index fund. Trades on the stock exchange. And so the reason we invest in index funds as opposed to professional managers or mutual funds is, believe it or not, the statistic is that over 15-year periods, and what I'm about to tell you statistically gets worse the longer you go out, but over 15-year periods, 90% of professionals, money managers, and mutual funds fail to match or beat their index. And that statistic is actually misleading to me, because what it says is if I look at 1,000 potential managers today, and I look at their 15-year history, I'm likely to find maybe 100 who've met or performed as well as their benchmark or better. But my challenge wasn't to do that. My challenge wasn't to look today, 15 years back, and see who did it. My challenge would have been to find the ones who did it 15 years ago and to have been able to stuck with them through all their idiosyncratic ups and downs and lasted the 15 years with them. I couldn't even calculate the odds of being able to do that. So we use index funds and we do construct the portfolio, to your question, for our clients. But the most important thing we do is to keep people adhered to their plan, and the behavioral counseling that we do, helping them fight the biases or systematic errors that we're all programmed to exhibit, particularly when we're dealing with uncertainty and money, to make the wrong decisions. That's the glue that keeps them adhered to the plan, is understanding the flawed belief system we have, and there are two of them, and the flawed behavior system we have. And there are three general categories of that I'll talk about with you, and then helping them to tackle those to be successful over the long haul with their wealth preservation.
Yeah, and I think that's a perfect segue into kind of talking about those things, right? Because I think the most successful people I know necessarily aren't the smartest or the wisest people. They're generally the most aware people. And based on the goals they're trying to achieve, and through that awareness, they're really good at making the right next decision that moves them forward towards that goal, right? And when they're trying to achieve it by. But oftentimes, most people either don't have awareness, or they've got some level of, subconscious programming that they don't know is there and it's holding them back, or maybe they do know about it and they don't want to change it. So talk a little bit about this psychology around money, some of these biases that have been baked into us from whether it's parents and family and generational stuff, or it's, society and cultural stuff. What are some of the things that you see are these biases that are not serving individuals that are actually trying to build wealth?
Yes, that's good. So I'll talk to you about the biases. First, I want to talk to you about the two flawed beliefs that we have, because it's all related.
Sure.
And it'll flow, I think, better for the audience. So if I hold this up, this is a $5 bill. But if I said to you, and it's not a trick, whatever comes to mind the fastest first, if I said in one word, describe what I'm holding up, what comes to mind?
Money.
Right. So 99% of people who come to mind is money. That's the first big flawed belief in all of our belief systems. Whether we're successful entrepreneurs or we just graduated from high school, it doesn't matter. We don't know the difference between what this is, this $5 bill. It's a currency unit.
Yep.
It's a peerless medium of exchange. I don't have to now go to the Tesla dealer and say, how many financial plans do you want for me to buy that Tesla from me? What kind of barter can we do, right? That's
right.
what this is. But what our culture thinks it is they think it's a store of value, that if I have, Jonathan, a million of these $5 million, a million of these $5 bills, my biggest challenge that I'm going to communicate to you as a potential investor that looking for advice is whatever we do in strategy, I can't afford to lose this $5 million. So as long as whatever you do, that's got to be at the heart of what the strategy is. You can't lose. So what the industry teaches us, and what we've been acculturated to believe, is that our biggest challenge as an investor is to protect our principal, the $5 million that I have, and not from even disappearing, right? Because if we invest in a diversified portfolio, and for this purpose, I'll just say the S&P 500 index, which is a broadly diversified example of a diversified portfolio.
Yep.
We would never have lost principal. We would have seen temporary declines in the value of our principal, and they call that volatility, up and down movements around the long-term uptrend. But we never would have lost it unless we did one thing, unless we sold into one of those temporary declines, the only kind we've ever had, and then created ourselves through human by a permanent loss of capital. Other than that, we've never had a permanent loss investing that way. We're at new highs almost today. So by defining risk and safety in terms of principal preservation, and not just protecting it or preserving it from disappearing, but even from fluctuating up and down, they call that volatility. The industry's cure for that is to tell us if we're generally looking at investing as owners of companies called stockholders, or as loaners to companies called bondholders. The industry tells us put more bonds in there because they don't fluctuate, and that protects us from what I call this illusory risk known as volatility. But when they misdefine risk and safety in terms of principal protection, instead of the right way to define it, in terms of protecting our purchasing power, right? Which is to say the value of each $5 bill today disappears to the tune of 3% a year to inflation, the cost of living increasing. And every $5 bill that I put into a bond today, that I roll over for the rest of my life into a new bond every 10 or 20 years, it's still only $5. It cannot appreciate. So in the safest way possible, they're giving me advice that will cause me to lose my money. The only rational definition to me is purchasing power, not currency. So by defining risk and safety now in terms of protecting my purchasing power from disappearing, I recognize that the advice I'm generally getting from the entire industry is causing me to run out of purchasing power or money. It's telling me to have 40% bonds, 60% stocks. That's the typical advice you hear for a retiree. And so in our world, what we do is we tell clients, they'll say, so you don't believe in bonds? And we say, no, we believe in bonds, but not for the purpose of reducing fluctuation. That's an illusory risk that if we try to protect it against it, we'll go into the real risk, which is killing all the dollars we put into the bonds designed to protect you from the illusory risk. So if we define risk and safety in terms of purchasing power, we recognize investing in stocks as owners of companies is the only way that I'm going to grow my dividends. The S&P 500 dividends have grown by 6% a year for the last 80 some odd years, twice inflation. So even if I start off, for example, with a 2% yield, in 12 years it's 4%, and in 24 years it'll be 8%, because that trajectory of the growth of that income is what's important. Grows much faster than inflation. Now the bond, even if I get a 10% bond, so if I give you an example, when I was born in the 1960s, in 1960 the S&P was about 60. Today it's about 5,500 or 5,400. So I've turned a million into 90 million. Inflation has gone from the consumer price index up about tenfold, from 30 to 300 or so.
Yeah.
So to buy what a million bought then, today I would need 10 million. I don't have that. I have 90 million if I invested as an owner of stocks through the S&P 500. At the same time, the dividend yield back then was about 3%, and the dividend, a dollar amount leading to the 3% yield, was $2. Today it's $72 that the S&P pays out if I invest in them. So that's now gone up 35-fold. So my 3% dividend of 30,000 per million is now giving me over $1 million in income. That's like getting 100% on my bond. Had I bought a 10% triple tax-free bond back then in 1960, and it came due today, I kept rolling it over, and it paid me 10% every year. But today it came due, I get back 1 million, not 90 million as I would have in equities. And the 1 million is maybe worth 100,000 after inflation, right? Because if inflation went up 10 times from 30 to 300, I need 10 million to buy what a million bought. I only have 1 million and it's only worth about 100 grand. And I got 100,000 in 10% tax-free income on that $1 million bond last year before it came due, instead of getting $1 million in the taxable stock income that's worth 700,000 after taxes. So in our world, what happens is we redefine what bonds are for by saying they're only for protecting against what I think the real risk of a retiree is, and that's called the sequence of return risk. What that means is I know that if I invest in equities over multi-decade periods, most of the multi-decade periods through history, I'll get something like 8 to 10% average over that long period. What I don't know is what each year in between now and my 30-year retirement is going to look like for the stock market. Will next year be up or down, and to what magnitude? So what if I retire this year, I have all my money in stocks, because I know that's likely to give me the best return over long term, but now the market's down 40% in my first 2 years. Now I'm forced to liquidate the stocks at a loss to supplement my living expenses. I don't want to do that. That's called sequence of return risk. What is each year going to look like, and how much is going to be up or down? So looking back historically, the S&P 500, from a peak to a trough in value and back to a new peak, that round trip has taken 40 months, call it 3 years. So what we advise our investors to do is take 2 years before retirement, set aside 2 to 3 years living expenses in cash or short-term bonds, and that's to protect against sequence of return risk. So for example, if somebody has $10 million and they're going to be spending 4.5% a year, which is what we generally recommend, that means they'll spend 400,000 a year. 2 to 3 years worth of that is about $1 million. So we'll have $1 million set aside in that side pocket, I call it, to protect against sequence of return risk, not to protect against volatility. Not a dollar to protect against volatility, not necessary. So now in our model, our client with the $10 million portfolio that has $1 million outside of equities is 90% equities. In the traditional model, they're 60-40 basically.
Mm-hmm.
And so that extra 30% in bonds, that's freezing their money. Think about this. For the next 30 years of retirement at 7% a year, if that 3 million were in equities, it would be 24 million at the end of the 30 years instead of still being 3 million. Think of the magnitude of wealth destruction that goes on when we define risk and safety in terms of principal protection, and we have that extra 30% in there to protect against what I call the illusory risk. So everyone can understand what I just said. Everyone I meet understands what the problem is getting people to stick with a 90% exposure to equities through all of the many fads and fears, the pandemics, the recessions, whether Trump wins or Kamala Harris wins, and I don't like the other one, whatever I'm afraid of, but not reacting to those things. Feeling the fear is okay, but reacting to them by changing your portfolio strategy in response, that's the killer. So that's where the behavioral counseling comes in. We get them to a better plan than what the general industry advice is going to get them to by oodles, but we keep them adhered to it by getting their behaviors in check. And so the second, by the way, belief, the first is currency and money are not the same thing. We think they are. The second is that risk is not volatility. Risk is the chance that my last dollar might leave me before my last heartbeat, that I run out of money before I die. And that's the only risk we really practically should be focused on mitigating and minimizing.
Right.
So those are the two flawed beliefs. Risk is not volatility and money is not currency. The three, now the more interesting part of behavior counseling in money planning is the three behaviors that are flawed. And then by category. So the first category, it's a physiological behavior. Doesn't have anything to do with what we think about or perceive. It's autonomous, and it's known as in common vernacular the fight or flight sensors. So at the base of our brain, we have these two organs shaped like walnuts called the amygdala. And they developed over millions of years with the idea of protecting us from life and death threats, right? The problem is today they've developed to be so fast responding and quick reacting. But the problem is we're not faced with life and death threats anymore on a daily basis. We have financial threats, and so the problem is that the amygdala doesn't know the difference between a bear in the woods coming to kill us and a bear market. The bear market is a temporary threat. It's a decline that'll come back. Always has anyway, historically. The bear in the woods is permanent. Amygdala doesn't know the difference, doesn't care. So What it does is autonomously tells us to do the exact wrong thing 3 days ago when the market's down 5%. Alarms go off, bear in the woods, bear market, I don't know, just get out of the way, sell. So autonomously, most people fail just from that. The second thing that I like to talk about is a cultural phenomenon, and it's how we process economic and financial inputs. So generally, the way we process is very rational. When we have an economic or financial decision to make, we behave in a way that's called counter-cyclical behavior. What all it means is that our demand is counter to the price of what we're considering, service or good. And so if the price goes down, it's on sale, we're attracted to it. And if the price is high and rising, we're generally repelled by it. Demand is counter to the price, counter-cyclical behavior. We behave that way with almost every financial and economic input except one. What do you think that one is?
Not sure.
The price of stocks. When the price of stocks is high and rising, like it was in 1999 during the dot-com bubble, human nature thinks that investing at those higher levels is somehow less risky than having invested at lower levels,
right?
And that my future return on the assets and earnings I'm about to buy at these higher levels will be greater than if I invested at lower levels in the same earnings, future earnings and assets that I'm about to buy. Conversely, when the price of stocks is temporarily down, human nature thinks that my risk of buying at these lower prices is somehow higher than it used to be when the prices were higher, and that my future return on the future assets and earnings I'm about to buy at cheaper prices is going to be somehow lower than if I would have paid higher prices. In just that one way, human nature is pro-cyclical. We're repelled by lower prices and we're attracted to higher prices. And it's a phenomenon that's hard to explain, but if I say it, the audience is listening and they're honest, everyone can relate to that, right? Everyone chased technology stocks in 1999, and everyone sold some or all of their stock portfolio in response to abject terror of the financial crisis, 15 or so years ago. So in just that one way, again, we're pro-cyclical. And then the last thing is emotional biases. So there are certain catalysts that cause us to behave a certain way that are psychological. So one is called loss aversion bias. Loss aversion. And what that means is it's proven that we feel the pain of a loss, financial or otherwise, 2.5 times greater than we feel the pleasure of a gain is pleasurable. And so because of that, and because of one other thing, which is that we're much more sensitive to the change in the value of our assets than to the actual value. So if I've accumulated 10 million, I'm comfortable with that already. It doesn't impress me every day. I don't think about it. But if I see last week that my 10 million declined 5% in one day, that $500,000 change downward, particularly because loss aversion makes me more sensitive to the decline than I would have gained 5%. I wouldn't have thought much about it. I expected. So because of that, what we do is we seek out strategies, not that maximize our chance of building long-term wealth, but that minimize our chance of short-term regret, short-term loss, and maximize our chance of short-term pleasure. That's why we want to chase NVIDIA until now it's going down, because that's short-term pleasure. I'm attracted to that. So because of that, we're doomed to fail based on one of the examples, loss aversion bias. One of the other related things to loss aversion, the other powerful emotion is regret aversion. So if I meet with an investor and they have $10 million, and let's say 7 million, they tell me they're sitting in the bank account in cash. First question I ask them is, well, is that set aside for a specific spending need? Tax bill, something. What is it for? If they say, once I hear the answer is no, it's not, then I tell them, I don't ask them, well, you have that cash for one of three or a combination of all three of these reasons. One reason is you have no plan, date specific, dollar specific. So you get the cash, you don't do with it. You don't know what to do with it. You keep accumulating it. Two is you did have a plan, but it backfired on you. So you've abandoned it. And again, you don't know what to do with it anymore. And three is you did something with some or all of this cash at some point that led to such a horrific result or outcome that in order to avoid that outcome, you don't want to have that regret. So you go to what's called status quo bias. Just leave it where it is. In this way, whatever happened to me before with that cash could never happen again. I won't lose it again. I won't, right? So it's one of those three that cause people to accumulate cash. So once we know that, and I'll give you a quick little anecdote if I can, that where we use this knowledge to help someone a number of years ago. So a person's referred to us, their grandfather left them $5 million, but they left it to them in the form of Merck, which is a big drug company, Merck stock.
Okay.
And the grandfather was a pharmacist. So the grandfather only bought Merck stock because we tend to believe irrationally that if we buy and invest in things that we know or familiar with, called familiarity bias, that it'll help us more and hurt us less than things we're not familiar with us. So what it does is cause us to concentrate or take way too much risk because we think because we know it, it's not risky to concentrate in it. Luckily for this person, his grandfather's concentration risk because of familiarity, but it didn't backfire. And he inherits 5 million. So he comes in to interview us. We go through the whole interview. At the end of the interview, he says, okay, I'm comfortable with what you're saying. What are the next steps? So the next step is we're going to sell the Merck stock next week when you transfer it in from the estate account. And I explained to him he has what's called a step up in cost basis. Grandfather died. This person doesn't have to pay a gain on the depreciation the grandfather has because it's assumed to have disappeared, the gain, when you inherit it.
Yep.
So there's no tax consequence. He said, he pushed his chair back. No, I'm not selling the Merck stock. So there were two things that were causing him to have that reaction. One is regret aversion bias. My grandpa accumulated all this money and left it to me by investing in Merck stock. What if I do something else with it and lose it? I don't want to face that regret. So status quo bias, leave it in Merck.
Yeah.
Leave it in Merck. The second thing, which is more fascinating to me, is something called the endowment bias. So it's interesting. When we own something and could lose it, when we own it already and could lose it, we value that much more than the same exact thing if we didn't own it and could acquire it. So the best example I give people is, do you own a house?
Yes, I own many.
Yeah. Okay. Well, let's assume your main house is, just for argument's sake, worth $2 million, and you're looking to sell it. And the broker you hire says, okay, the comparable sales, Matthew, in your neighborhood are 2.2 to 2.4 million for the same kind of house. What would you list the house for, price-wise?
If it was
that information.
Between
if they say the comparable sales are now between 2.2 and 2.4 in the neighborhood.
Yeah, I mean, I guess it just depends on your strategy
Not a
and
trick question. Really,
your
strategy is to
timing,
get the
but
most
yeah, I mean,
money.
you'd list it between 2.4 and 2.7.
Right. And if you were going to bid on the same house, buying it, how much would you bid?
I'd probably bid somewhere in that window on the low end.
Right. So you valued the same asset differently based on whether you own it and could lose it or
Depends on
whether
what
you.
side I'm on.
Exactly. So that's how we work with everything. But with this guy, so knowing that, I said to the person, so let me ask you a question. If instead of inheriting Merck stock, you inherited 5 million in cash, and at the end of the meeting you said, okay, after we went through the planning and how much you need to spend, I said to you, you said, what are the next steps? And I said, the next steps are you'll transfer the cash in from the estate account, and Monday morning we'll go out and put it all in Merck stock. What would you say to me? He said, I'd say you're crazy and I'd run out of your office. I said, but think you're making the same decision now because of endowment bias and because of regret aversion. You're basically, with no taxes, you're saying, I want to keep it all in Merck stock. Same decision.
Yep.
But just because of the endowment bias thing, so we broke through it and got him to adopt a plan that was going to help him because of that.
Very brilliant. I love that. Now, talk a little bit about the difference between those who are doing all the right things and those you see doing a lot of the wrong things when it comes to building their wealth, whether this is early stage or even people that have already accumulated some great success.
Well, so I'll start with the latter because I think that's more interesting. So the people who have accumulated great success, like one of the podcasts I was a guest on recently, they said, so what I'm confused about is you get these wealthy people you're dealing with. Our minimum's $5 million. So these people are already successful. Why do they need you, right? They were like, so I said, well, it's a good question because people who've accumulated that wealth, most of these people didn't do it by virtue of their great skills as investors in the financial capital markets. They did it because they were great entrepreneurs, great executives, et cetera. And the
Correct.
skills needed to succeed as a great entrepreneur or executive, for example, if you're an entrepreneur of a company or an executive of a company, companies today, big companies usually have many divisions. And if you're looking as an executive quarter by quarter and you say, hey, this division for the last 3 quarters is terrible, and these three are great. I'm going to take capital that I was investing in these losing divisions, and I'm not going to put it into the winning. That's rational behavior, right? I'm managing a company. The problem is those people, the same people, look at their investment portfolio the same way, but it's different, right? So if small cap stocks, small company stocks have underperformed large companies for the last 5 years, I want to buy more of them. But they're looking at it as the small company stocks are my losing division. I'm going to sell it and I'm going to put more money into the expensive stocks
Mm-hmm.
because that's my winning division in their mind, right?
Right.
So they're more challenged than the average person because they have that bias and then they're also overconfident. They succeeded in business or executives and now they think that success is translatable to be able to succeed as investors when in fact the skills you need to succeed as an entrepreneur or even an executive, you have to be willing to take big risks that are against very long odds of success. You want to do it quickly and you want to get out and do it again. And investing requires the exact opposite skills. You don't want to find the best thing you can find, the best returning thing you can find. You want to find average returns that you can stay with for the longest period of time. That's compounding, where time does all the heavy lifting. They're not used to that. So,
Yeah.
so that's part of the problem with succeeding. In succeeding to protect wealth, it requires a very different set of skills than succeeding to build and grow wealth to begin with.
Let's circle back to two different people real fast. One that is a new investor that knows they're going to be successful. They're confident, they're going to make money. What are some of
Right.
the things they should be thinking about and doing today at the very beginning of their journey? What's your advice to that individual?
Yeah. So my best advice to someone like that who says, "What's the most important thing I could do with the money I make to make it grow the most? I'm working hard. What do I invest?" So I say the single biggest variable, single biggest thing you could focus on is to increase your time horizon the longest possible. Start doing it as early as possible.
Yeah.
It's doing it as early as possible. That's what's going to give you the biggest wealth. Getting average returns for an above average period of time is going to lead to extraordinary above average results. So at the end of the day, what I told you, $1 million in 1960 turned into 90 million today. The return on that was something like 7.5% a year without dividends. Average market returns, all it is, but
They just had
extraordinary
time.
results. So that's the best advice I can give anyone. The common denominator again for most great investors, Warren Buffett included, is not that they found the best returning things all the time. It's that they had the endurance and the longevity to survive through the pandemics and the recessions and stick with their plan and let it keep compounding. Not as Charlie Munger, Warren Buffett's partner who passed away this year, said, the most important thing about compounding is to never interrupt it unnecessarily. And by reacting all the time to these things and changing it in and out, that's what people do to cause themselves to fail, and they interfere with the compound.
In a perfect world, what do you say to the $10 million investor that might be doing a decent job, but what are some of the blind spots you see them missing in terms of not a mindset perspective, but an execution or a habitual perspective when it comes to how they manage, oversee, and engage with their portfolio?
Yeah, so basically, this again is a broad brush generalization, but applies to most people, is they're going to suffer from the same human nature. So in other words, right now, if you look at most of those people's portfolios, if they're handling it themselves, I can tell you without looking at it that 75 to 90% is going to be in the US as opposed to international. 75 to 90% is going to be in large caps, large companies. And of that, probably 80 to 90% of the large caps are going to be in technology. And most of it in what they call the Magnificent Seven.
Yep.
NVIDIA, Facebook, that's it. So it's the same problem. So they don't diversify because, by the way, going into the year 2000, when the technology bubble burst, what ended up happening is people had the same experience then going into 2000, meaning from 1990 to 2000, as they've had pretty much from 2010 to 2020, which is large technology companies led the way above all else. But then it was different names. It wasn't NVIDIA and it wasn't Microsoft. It was Cisco Systems. It was AOL. It was WorldCom. It was Lucent Technologies and those types of companies. Same thing, though. And then for the next 10 years, meaning after the technology bubble burst, the next 10 years, it was the NASDAQ Technology Index lost 60%. Small caps, which had been doing nothing for the previous 10 years, went up 60 or 75%. Emerging markets, which had done nothing, went up at 1.200% from 2002 to 2008, all while everyone had just sold all those things in 1999 to pile in to the most expensive stuff, the S&P and the technology stuff. They're doing the same thing today. And so the $10 million client, the $1 million client, they're going to likely exhibit the same thing. And the biggest mistake is not just that. The biggest mistake is they're making two mistakes. They're selling what's about to likely do well for the next 10 years to buy what's likely about to go down for the next 10. But then they're going to conclude at the end of the NASDAQ going down for the next 10 years, like in 2010, they're going to conclude the wrong thing and they say, investing just doesn't work. I got to put my money in bonds. So now they lost two ways. They sold everything that was about to go up 70 to 200% to buy what was about to go down 30 or 40 or 50 or 60. But then they also killed probably a 5 or 10 year window that they're not going to invest for anymore because they're licking their wounds thinking, I'm not blaming myself for over concentrating at the wrong time and the wrong things and taking investing and turning into speculating. I'm blaming investing. I'm calling it that investing doesn't work. So now I'm going to go and sit in cash because I don't want to regret that again. So regret aversion is going to sit in cash. So they lost two ways. And that's a huge problem. And so the second part of that, by the way, for the overconfident entrepreneur, whether it's the husband or the wife in a marriage, they're the ones that fancy themselves capable of doing all these things because they don't realize it's one part what they know, and they know a lot, maybe intellect, but it's 99 parts temperament, and they all suffer from the bad temperament. We all suffer from that. So what they do is they fail to recognize that what if something happens to me? My spouse doesn't have or think they have the skills I have. So now I'm doing all this. Something happens to me. They don't even know what to do because I don't have a plan. I don't have a fusion family. Or they're just, so it's without meaning to, a lot of successful people become very selfish without realizing they need to provide some continuity with something very manageable and definitive for their family to follow.
What's your outlook on the current market and future market in the near short term?
I don't have any short-term views because I can't tell you, is a pandemic, God forbid, rolling around the corner? Is a war about to break out? So the short term, the one thing I know in the short term is people should have no views on the short term if they're going to succeed for the long term. Their view should say, hey, what's my objective? I want to accumulate X amount by X time. And I know over the last 100 years, equities, as opposed to bonds, have made about 10% a year. Bonds have made about 6. The equivalent companies in bond form have made about 6. After inflation, equities have made 7, the 10% minus the 3 of inflation, and bonds have made 3, the 6% minus. So I know that I need to have more of the 7s than the 3s if I'm going to reach my goal. And whatever happens next year isn't going to change the fact that over the next 30 years, I'm likely to see that relationship because it's always been there, making 2.5 times more as an equity investor. And once you focus on short term, all the lights go out because it's irrelevant.
Yeah, I love that. I know you're a crock pot versus a microwave guy. Long term.
Yeah. Well, think about it. You say, well, whatever. It's something this is my own term. It's not a term that's out there already that I've seen anywhere, but I call it the illusion of predictive value. So asking me, not you, anyone someone asking me as an advisor, what do you think is going to happen? And therefore, because you think it and I trust you, I'm going to think that the outcome is likely to reflect your thought. I call that the illusion of predictive value, that my thought, your thought, or Warren Buffett's thought has any relation to what's actually likely to happen over the next year. It doesn't. Yeah, but if you believe, right? So it's just a fool's game.
Now, what's your outlook on holistic investing with pairing a portfolio to real estate, to life insurance? What other healthy components in a well-balanced portfolio, in your opinion, pair with your investment and wealth building thesis?
So I'm very open-minded, as to what people's preferences are. In other words, if somebody comes to me with 10 million, what I know is by investing in equities, global equities, that's their highest probability, in my view, of gaining exposure to every major company, sector, industry, and geography in the world, right? Yep. Without a lot of effort. Yeah. And that over time, we've made close to 10% a year over multi-decade periods, and the incomes have grown. So to me, the question becomes, from a practical standpoint, I would ask the client, how is owning this real estate, this alternative investment, this whatever it is, going to increase your chance of success in the way we just defined it? And it's really not, right? It's not. So the question is, okay, so why do you want to own it? And if they want to own it because, hey, I feel like real estate is just a great thing and it's tangible and it's whatever, I can touch it. Because what we also tend to have is a misperception about owning great companies like Apple and Merck and Nike. We said, people say, oh, it's just a piece of paper. It's no more just a piece of paper that evidences my percentage ownership of Apple and their earnings in the future than a deed is a piece of paper evidencing my ownership in a building, right? True. It's irrelevant. I can go and touch any Apple store. I own a piece of it, but we don't think of it that way. Sure. So at the end of the day, what I like to do is say, okay, if I need 9 million to make sure that we have a high probability of getting into your income and asset goals to be able to retire comfortably, take 1 million and do Bitcoin or real estate or whatever it is that you want to do for whatever reason, and just don't come back to me and ask me for another dollar if it disappears. And I hope it goes to 10 million. But I'm not going to help you shoot yourself in the foot and take a fee for it. I know I need this 9 million at roughly an assumed 8% a year to get you to your goals comfortably and keep you there.
Love it. Love it. Now, I know a lot of people.
By the way, if doing something else helps them stay to that core piece, that's great. I encourage them to do something else.
Right. Right. Now, I know a lot of people are going to have, additional questions, some follow-up, maybe want to learn more about your services and maybe their own specific and unique situation. So where's the best place for them to connect with you and learn more?
Yeah, thanks, Matthew. So we're accessible information-wise on our website, fusionfamilywealth.com. And my email's there, my cell phone number, everything is up there. We're pretty open about it. There are also in my insights section on the website. For example, we just put out a newsletter to clients on Monday. We have some great newsletters that are very well received. We have podcasts, so people can go onto the insights section, the podcast section, and see our newsletters. And then in the fall, we're coming out with our own podcast called Crazy Wealthy. So be on the lookout for crazywealthy.com. And crazywealthypodcast.com will be coming at you in the fall with that.
Awesome. We'll be sure to link up all that on the show notes at millionairemindcast.com on Jonathan's episode. Jonathan Blau, thanks for coming on the show.
Pleasure being a guest. Thanks again, Matthew.